Okay, I think we should get started, and whoever else isn't here because they were late can just catch the recording of the webinar, which I'll post up on the website. So tonight, first off, I'd like to say thank you and just get the legal stuff out of the way. So thanks for joining me tonight on this webinar. I'm not a financial advisor, I want to stress that, or a financial planner or any kind of investment guru. I'm not giving any advice, be it financial or legal or otherwise. The information I talk about here is freely available online. And if you decide to take any actions based on what you see here, they are ultimately your responsibility. What you do with your money is pretty much up to you. I will show you what I am doing myself, but please seek professional advice before taking any action for your own investments. What we're looking for as property investors in general is lots of low-priced, good-quality properties that we can take advantage of. We're looking for good rental returns with good tenants, very key factor over there, tenants that actually pay their rent. So it's all fair and well doing forecasts and analysis on the possibility of good rental returns, but unless we've got good tenants actually paying the rent, we're not getting any money in. So we're looking for that. We're looking for the probability of long-term capital growth. By probability, I mean I don't really like measuring capital growth too much in my forecasts, purely because it's a maybe figure sometime in the future that might happen. So I kind of focus specifically on income, and if the capital growth happens, that's nice, but we want to find properties that have at least the probability of good long-term capital growth. Then in this particular one, I'm looking for US dollar-based income to offset against the rand, the volatility of the rand, and also a bit of a plan B, something an investment outside of South Africa so we can offset our risk a little bit, being an emerging market, third world country, that type of thing. We've got a little bit of political instability, and we see it every time the big markets, the first world markets, have a bit of a fear factor associated with them. Everybody exits emerging markets, and we sit here in South Africa, and our rand takes a bit of a beating, and we lose money. So we want to be able to offset some of that risk by generating US dollar-based income, or at least income in a currency that is based in the first world somewhere. Euros are a little bit dodgy about the euro at the moment because of the Eurozone crisis, but pounds, dollars, something outside of rands. So the beginning of it all was the housing bubble. In 2000 to 2005, roughly, there were very low defaults on mortgages. A lot of people were making a lot of money. The housing prices were going up continuously, pretty much the whole world over. We had very great growth here in South Africa, and the USA saw exponential growth. It was mind-blowing. The builders were going nuts because the demand was so high. Everybody was just developing. It was very easy to get credit, so they could do building. People could buy second, third, fourth properties, that type of stuff. So credit was easy to get, and everyone was making lots of money, and the interest rates were really low to stimulate that massive amount of growth. And then the beginning of the end happened. Basically, with the subprime crisis, everything went a little bit belly up. So I'm just going to play a short video here. This is an extract from the Inside Job, talking about the subprime crisis a little bit. It's about 4 or 5 minutes long, and you're just going to watch that quickly just to give you a general idea of what happened right in the beginning. Come on.
In the 1980s, the financial industry exploded. People on Wall Street started getting rich.
I had a friend who was a bond trader at Merrill Lynch in the 1970s. He had a job as a train conductor at night because he had 3 kids and couldn't support them on what a bond trader make. By 1986, he was making millions of dollars, and I thought it was because he was smart.
I have several colleagues, 2 of whom are actually in the film, Ariel Rubini and Charles Morris, who were among the earliest people to warn about the coming of this crisis. And they began telling me something really bad is coming in the financial world, really big and really bad.
Share prices continued to tumble. Lehman Brothers was forced to declare itself bankrupt, the largest single point drop. The regulators, they had the power to do every case that I made when I was State Attorney General. They just didn't want to.
My principal purpose in making Inside Job was to explain to the American people what had happened to them.
Borrowers had borrowed on average 99.3% of the price of the house, which means they have no money in the house. If anything goes wrong, they're going to walk away from the mortgage. This is not a loan you'd really make, right? crazy. But somehow you took 8,000 of these loans, and by the time the guys were done at Goldman Sachs and the rating agencies, 2/3 of the loans were rated AAA, which meant they were rated as safe as government securities. It's utterly mad.
One of the most extraordinary things about this whole period, the bubble, the crisis, the response to the crisis, has been the complete lack of accountability of the people who did this.
Lehman Brothers, A2 within days of failing, AIG, AA within days of being bailed out. Fannie Mae and Freddie Mac were AAA when they were rescued. Citigroup, Merrill, all of them had investment grade ratings.
How can that be?
Well, that's a good question. That's what the regulators, it's their job, right? Their job is to understand the exposure across these different institutions, and they have a very refined understanding that I think became more refined as the crisis proceeded. So,
forgive me, but that's clearly not true. I mean,
what do you mean that's not true?
I was stunned on a fairly regular basis in the course of the research for the film, and also during the interviews for the film. Many of the things that people told me.
Going to stop it there. So as you can see, if you haven't seen the Inside Job, do yourself a favor, go and watch it. It is mind-blowing what actually happened there and how all of that came to be and the effects that it had on everybody. So effectively, the subprime crisis was about those subprime mortgages, and a very high percentage of them were extremely low quality, where people couldn't actually afford the repayments. A lot of them were what they call adjustable rate mortgages, which is very similar to what we have here in South Africa, which is it's an adjustable rate mortgage or a bond that's linked to the repo rate, that type of thing. So it's not a fixed rate mortgage. What's key about those adjustable rate mortgages is a lot of them had incremental increases at specific time periods. So the guy would start out on a very low repayment, and then they would say, well, within 5 years, the capital growth would be in the property and you should be earning more because your salary will be higher, et cetera, et cetera. So then it would have an incremental jump. So let's say from $300 to $800 a month. And then another 3 years later would have another incremental jump to $1,100 or $1,200 a month. So those adjustable rate mortgages were extremely dangerous because when those incremental jumps happened, a lot of people couldn't afford those extra repayments, and especially when they saw their property prices dropping while their bond repayments were going up, they'd actually just, they call it jingle mail. They just put the keys in an envelope and send it to the bank and move out the house, and the bank forecloses, and that's it. So it was an incredible thing to happen in the United States. It was very widespread, and it was mind-blowing how bad it was. Then the securities that were backed by these subprime mortgages, so basically they took little bundles of all these subprime mortgages and then resold them to insurance companies, to investment companies, to investment banks, that type of thing. And it just created this thing where there was no responsibility or accountability anymore because the loans just got passed from one person to another. And an interesting fact here is the ratio of debt to disposable income in the USA went from 77% in 1990 to 133% by the end of 2007. So people still owed way more, or at least the amount of money they had to repay compared to how much they were generating in income was a lot more. So they were in big doodah. So it's basically one BAP. I call it a big ass problem that created the entire world financial crisis. And these adjustable rate mortgages, as I was saying, as they were resetting at higher and higher rates, it led to higher repayments, it led to defaults, which led to foreclosures, lots and lots of them, and which ultimately led to the entire banking industry having a huge problem, and lots of the big names like Lehman Brothers crashing, Bear Stearns getting bought out by one of the big banks. So it was just a mind-blowing thing to happen, and it's created this opportunity for us with these properties that are there at very cheap prices. This is another video here from, and this is only about a minute long, so I'm just going to play this quickly. It gives you an idea of the type of packages that these banks were buying. This is Goldman Sachs bought a particular package of loans, and just have a listen here and see what he says.
A friend of mine who's involved in a company that has a big financial presence said, well, it's about time you learned about subprime mortgages. So he set up a session with his trading desk and me. And the techie who did all this gets very excited, runs to his computer, pulls up in about 3 seconds this Goldman Sachs issue of securities. It was a complete disaster. Borrowers had borrowed on average 99.3% of the price of the house, which means they have no money in the house. If anything goes wrong, they're going to walk away from the mortgage. This is not a loan you'd really make, right? You've got to be crazy. But somehow you took 8,000 of these loans, and by the time the guys were done at Goldman Sachs and the rating agencies, 2/3 of the loans were rated AAA, which meant they were rated as safe as government securities. It's utterly mad.
So what does this all mean? Where does this leave us little people over here? Effectively, the housing bubble and the subprime crisis led to mass foreclosures, financial meltdown of the world, and a long-lasting worldwide recession. And we're sitting here with a massive opportunity, being a bit of a savvy investor, to take advantage of that situation. According to Time magazine, there are roughly 1.7 million homes in the foreclosure process in the USA right now, as of August 2011. That's a lot of stock available. About 11.5% of USA homes are currently standing vacant. What that means is a lot of those foreclosed properties that are in the foreclosure process, or at least have been foreclosed on, are standing vacant because they haven't been sold, and the banks are also not renting them out because that's not what they do. To put it in perspective, Bank of America actually bulldozed 100 foreclosed homes in Cleveland recently, purely because they can't handle the amount of property taxes they have to pay, homeowners association fees they have to pay, and all of these expenses related to these properties that are standing vacant. And as you know, if a property stands vacant, it deteriorates over time. So if you end up in a situation where there's maybe 40 or 50% of a townhouse complex or a condo complex standing vacant, the entire complex is in trouble because they're not getting those homeowner association fees, and that means it's going to deteriorate at a rapid rate. Wells Fargo, for example, donated 800 homes to municipalities since 2009. JP Morgan donated or sold roughly 1,900 homes to city officials at stupidly discounted rates, purely so that they could get out of those properties so that they don't have to pay those property taxes anymore. Where those Bank of America homes were bulldozed, they actually just made that a green area in Cleveland. So they knocked it down and donated it, and that became a green area so that they could get rid of that expense on their books. What also happened over this time period, since about 2007, when the whole crisis began, there have been about 3 million foreclosed homes go through the system in the USA, which is a lot of property. And they expect it to reach a total figure of around 6 million by 2013. So that means we've got about 3 million homes that still need to go through the foreclosure process over the next 2 years. That means we've got about a 2 or 3 year window to take advantage of this particular situation and be able to buy these homes at such cheap prices. What happened, though, in the last 6 months, 7 months in the USA is they effectively stopped the foreclosure process in a lot of the big banks because they found that the foreclosure process was taking a year to 18 months because of one particular legal aspect. There was a lot of fraud going on with all of these mortgages that were getting sold, and people were just going nuts. They were buying second homes, third homes, fourth homes, refinancing the existing homes, that type of stuff, and they weren't actually signing the contracts. There's a system called robo-signing where the guy wouldn't even go into the bank. He'd just get the keys for his new house without actually signing the contract physically himself. And what that did was when these homes started going through the foreclosure process, a guy would stand up and say, but I didn't sign the contract, which means the bank is sitting in a very tight situation because they now have a situation where they foreclosed on the home. This guy says he doesn't own the property because he hasn't actually signed the contract for it, which means they can't hold him liable for the difference between what the home is sold for on foreclosure and what the guy actually owes. So if it's sold for $50,000 and he owes $100,000, they can't sue him for the other $50,000 because he didn't sign the contract in person. So they had this big problem with a whole bunch of these loans, and it created absolute havoc. So they stopped the foreclosure process for about 6 months, and all of those foreclosures that were going to come through kind of started backing up the pile of homes that had to come through. And what's happened now is they're slowly starting to figure that stuff out, and the foreclosure homes are actually starting to happen now. They're starting to come through little bit. So that means those homes that were sort of backed up in the system are now going to come through a lot faster. And just another little key factor is that California remains the hardest hit amongst the U.S. states, accounting for nearly 25% of new foreclosures in June this year, followed by Florida, 23,800, and then Arizona, number 3. We're focusing specifically on Florida at the moment because of a whole other bunch of aspects, good employment, very good infrastructure for the tourism industry, that type of stuff. So we're focusing on Florida, but California is a very key state as well. There's a lot of stock available over there. There's good opportunities for employment because of the tech industry in Silicon Valley. So we're going to be focusing on that next year. But for now, Florida is our key focus because we've already built relationships there in the USA and Florida. So what do we need as investors? We need lots of good quality properties, good rental returns with good tenants, and the probability of good long-term capital growth. So we're going to focus here on lots of low-priced properties. Let's have a look at what do we mean by low-priced. So the Standard & Poor's Case-Shiller Home Price Index is the leading measure for the U.S. residential housing market. It tracks changes in the value of residential real estate nationally as well as in 20 metro regions, and then they break it down into 10 metro regions as well. So if we look at that graph, if we look at the average property prices here, this is measured, if you look at the graph going up on the y-axis, it's measured in thousands of dollars. So it starts at $50,000, $75,000, $100,000, etc., etc. So if we take the average prices of all the properties in the USA over the last 14 years or whatever, and we can see here that they peaked in 2006. They're at around $225,000 on average. Then they rocketed down after the subprime mortgage crisis, and they leveled out here at around $150,000. So you can see that's about a 33% drop in value across all the averages. So from the $100 million properties right down to the properties that you can buy for $1,500 standing empty there in Detroit. Yeah, you can actually buy a property for 10,000 Rand. I don't know if you really want it, but they're there. So this takes into account the broad spectrum of everything. And what everybody's fearful of is the double dip. Basically, it means that, yeah, if you have a look here, if you can see my mouse, it dropped from $225,000 down to around $150,000 on average. But they're fearing that it's going to drop in a second leg, the double dip, where it's going to go down even further. And I'm saying that it's actually already happened. The double dip, the properties we are finding that we can actually buy, the real estate owned property, which is basically a property in possession by the bank that's been bought back on foreclosure and is now a bank owned property. We're buying them at 60, 70, 80% below peak value. So the double dip has actually already happened in a particular segment of the market that we are focusing on. In that range between about $60,000 and $150,000, they've dropped astronomically right down to about a third of their value, a third to about 40% of their peak value in 2006. So this means we're sitting in a situation where they are extremely cheap. They're about as cheap as they can get without somebody actually paying us to buy them. So I'm saying, if you want some proof, the property we bought in Orlando, we took transfer of it at the end of September. Its peak value was $138,000 in 2006. Our purchase price that we bought it for now was $40,000 with all costs. That includes closing costs, conveyancing fees, repairs and maintenance, courier costs for documentations from South Africa to the USA, etc., etc. We came in at $42,700. And the launch price when it was built in 1984 was $40,000. So we actually bought it at its initial launch price of nearly 30 years ago. And if you want to know about rental returns on this particular property, I'll get there in a minute or two. So if you want more proof, I've prepared a live search right here. We can go and check it out. You can use these tools as well yourself. Let's just escape here and go and check here. I use Zillow.com and Realtor.com just to find properties very quickly, and then I use a whole bunch of other tools to analyze them, and I also use a realtor based in America to actually find out the details for us and verify the details. So I did a quick search of properties between $50,000 and $60,000 in the States. We came up with in Altamonte Springs in Orlando, and I know that area pretty well because we drove it flat while we were there in May this year. So we know that it's a reasonably good area and that we can get decent rental returns. I'll show you how we check the rental returns now. So we've got here $60,000 for a 4-bedroom, 2-bathroom home. We've got here 3-bedroom, 2-bathroom home for $50,400 and some change. 3-bedroom, 2-bathroom for $60,000. So if you're going to have a look here at this one, that's the $50,429 property. So 3-bedroom, 2-bathroom home, roughly 1,100 square feet. That's, call it about 105, 110 square meters. It gives you a little bit of history here. I can also verify some of the information about this property just using another tool called scpafl.org. So we can just verify what the actual property taxes are and if they're up to date. So we can see the property taxes for this year are $464 and it's up to date. So once we've found this property, now we need to figure out, okay, well, we can buy something here for roughly $50,000. What kind of rental can we get for it? So if we go and check what kind of rental we can get, we use Zillow here, and if we look at that same area, Wethersfield there right in the middle, you can see there's a property going for $1,100 a month. There's another one going 3 bedrooms, 2 bathrooms for $1,200 a month. You can see there $1,300 a month. So we can see there's quite a few in that little area going for more than $1,000 a month. So then we go back and we say, okay, let's actually measure the investment properly. Let's use Hannes' system, that's Dr. Hannes Dreyer. I use his Property Pro software to analyze the property and see what kind of internal rate of return I can get from it. So if we come here and we put in the purchase price and I say, okay, with closing costs and maybe a few repairs, we're going to sit here with a purchase price of about $55,000. Now, if we're paying cash for it, we need to measure how much money we're physically laying out of our own back pockets in order to measure our internal rate of return, to measure our growth. So I'm going to say, okay, we're actually paying cash for it out of our pockets because in America, we have to buy cash. There are no mortgages to be had because the banks won't loan any money right now, especially to foreigners. So we have to buy cash. In fact, with real estate owned property, we actually have to have the money available in the United States in US dollars, and we have to show proof of funds with our offer to purchase as part of the documentation before they'll even look at the offer. So we have to buy cash. Then we come and we plug in some of the variables over here. So we can look at interest rate. The interest doesn't really apply at the moment because we're paying cash for it. We'll bring this in if we're using another method, if we are funding it out of borrowed money from South Africa here. For example, if somebody extends a bond on their existing house here in South Africa and moves that money over, then we'll analyze it using the interest rate. The inflation rate in America at the moment is about 2.7%. That's what they say. I don't believe them. They've had about a 200% increase in sugar. I need to verify this. I can't remember the source that I actually read this on, but yeah, about a 200% price increase in sugar over the last year, about a 23% increase in the price of petrol in the last year. So inflation is a little bit skewed, but let's double what they say and measure it at 5%. Another key factor here about second-hand property in the USA is that we can depreciate it over 27 years, the full value of the property. So we plug that in over here. Then capital growth. I've put in here 5% per year, but in effect, I don't like measuring capital growth, but just for this particular purpose, let's put it in and see what the figures come out at. Monthly expenses, you saw the property taxes there a bit earlier was 400 and something odd dollars per year. It roughly works out to about $40 a month. If we take out an insurance policy for public liability insurance, that's about $35 a month. Obviously, if somebody has an accident in the house or a tenant falls down the stairs or whatever the case may be, you want them to be able to sue the company or the insurance company and not you in your personal name. So that's why we have public liability insurance there. It's the United States. They can sue anybody for anything. So anyway, and then the body corporate fees, if it's a homeowners association, we plug that figure in there, $250 a month. We need to verify that figure, which I use. If we send the details of this particular property to our estate agent there in the USA, he pulls the multi-listing service sheet and on that sheet you can verify the homeowners association fees. You'll then also phone the homeowners association and just check what the actual amounts are. Excuse me. Then we can come in and plug in repairs and maintenance and tax options and all the rest of that stuff. I'm going to do the basic ones here just to show you how we analyze the property. On any income up to $17,000, split between a partnership, two people sharing the property, we can distribute the income to offset the tax up to about $17,000. So up to there, we're in a 10% tax bracket. Then the rental income, roughly $900 a month. I've plugged in over here. You saw that the other properties were about $1,100, $1,200 a month. So let's just put it in here at $1,000 roughly. And then management expenses, I've put in a vacancy rate here of 1 month per year. Just so that if somebody moves out, we've got a few weeks to market it and get another tenant in, etc., etc. And then the managing agencies that we use over there, on average, are between 8 and 10% of the value of the rental that they take for their fee for managing the property for us. And then we just click on the assessment, and we should be able to see some figures here. Just want to check here, there was a question. So now we can see here, analyzing that particular property, now we've paid cash for it, and we're looking at these figures here. We can see after tax, we're clearing out around $469 a month after all expenses related to it. And our internal rate of return, this is our real growth on our investment, is about 7% in the first year and about 13% over 5 years. What's key here is our cash on cash. Our actual yield is about 10%. So everybody talks about net yield, gross yield, etc., etc. Our net yield here is about 10.25%. But if we use one particular aspect of this investment and we change it from paying cash for it to actually financing it from a bond here in South Africa, what would happen to our investment? So let's say we borrowed all of the money here in South Africa and we sent it over there and we bought the property with that cash. Remember, we're measuring how much growth we're going to get from our actual money we're taking out of our back pocket. And all of a sudden, it changes completely to an infinite internal rate of return. What that means is we're generating positive cash flow out of a property that we've used leverage to get. So we use a signature to get the money instead of our own money out of our back pocket. And we're getting $60 a month actual positive cash flow. Remember, what I've done here is I've used 7.5% as the interest rate, but I also do, I used in general a 10-year moving average and measure it that way so we can see what our worst case scenario would look like. So the 10-year moving average is about 13%, and then we can see how much money we actually have to lay out if we're borrowing the money at 13%. And then we can see here that we've got a slight negative cash flow, but we've got a 47% growth over 5 years on this particular property, which is phenomenal. You can't get 47% growth in any other investment anywhere in the world. So if you know what you're doing, you can create a property investment out of this particular environment very, very powerfully. I just want to show you something quickly. The analysis for our property there in the States right now, it's 4647 Ringneck Road, and that's a little photo of it. If you have a look at our assessment here, you can see we're getting around $7 a month positive cash flow. We did take an extension on our existing mortgage here in South Africa to fund the purchase of this property, and we're getting an infinite internal rate of return. So we're getting positive cash flow out of nothing, and that's taking into account only a basic 5% capital growth rate. If we change that to 10%, and I'll show you why I believe capital growth might be really, really good over the next 10 years, but I don't like measuring it just because it's that maybe figure sometime in the future. But just for the sake of this exercise, let's look at what happens. We've still got an infinite rate of return, but if we go and have a look at our value over 20 years, look at where we're sitting. A property roughly $750,000. $745,000 in year 30. So it's phenomenal what this actually is. So let's get back to the nitty-gritty over here. So as you can see, we did a live search over there. We found a property, we compared it, and we had a look at the figures. And there are lots of those properties available. In fact, we're averaging a gross yield of about 25% for the properties that we find, and a net yield of between 10 and about 15%, depending on if it's a condo and it's got homeowners association fees associated with it, and if it's a freestanding single residential home, then the property taxes are a little bit higher and the maintenance might be a bit higher. But the fact that there's no homeowners association fees means that your return on investment can be slightly higher. So those single residential homes can yield net yield up to about 15%. So we're looking for good rental returns. So the foreclosures that led to bad credit scores basically meant that the people that had been foreclosed on couldn't buy anymore. So for the last 3 or 4 years, those people that couldn't buy are in a situation where they have to rent because you physically can't buy. And because a whole bunch of other factors driving the growth of the rental returns, like the fact that because the banks didn't have any money to loan out for new developments, a lot of self-funded investors are still doing fairly well, developing new properties over there. But because the second-hand market is so rife with these real estate-owned properties, the investors are having a really hard time of it. So they're not building any new properties, or at least very, very little new buildings are going up. And the population size in America is continuing to grow. It's grown at about 10% over the last 10 years. And at the moment, Reuters reckons that the USA population is sitting at about 309 million people. So as you know, we just passed 7 billion people in the world. The population is really, it's not slowing down, it's speeding up. And that's going to create a supply and demand problem on rental, especially if people can't get access to credit. So it means they have to rent, which means the rental demand is going to be very, very strong, and is very, very strong in the States at the moment. So what kind of rental returns can we get? I showed you that earlier on the Property Pro software. On our property at the moment, we're getting about a 10-11% net yield. We're getting much better than that for other people who are buying single residential homes at the moment in the States. So I've done the Property Pro test, so that you saw that earlier. Now we're going to talk about the probability of good capital growth. Now, just before we go into that, we had a question here. So what is the average property price we're looking at in the USA starting off? I would say we bought for $40,000, and if you're looking for anything in a decent area, you've got to start in the region of $40,000 to $60,000. The really good returns that we're finding are anywhere between $60,000 and $100,000, but we can find stuff for around $40,000. So I hope that answers your question. And then another question that came through, do you leave money in the USA or do you pay your bond this side? It depends on how we structure it. If I've got enough money to pay it here, I can pay it here, but I can also bring it back. I use a credit loan account, and when I bring it back, how it's structured at the moment is because of the dual taxation treaty between South Africa and America, what it states in essence, I'm not a tax expert. I've spoken to a few tax experts, and what it boils down to is that wherever the transaction takes place, that's where you pay tax. Now, what's key about that is if you've only got a small property portfolio in the United States, you're going to be in that 10% tax bracket, whereas in South Africa, if you're earning fairly well, you're going to be in the marginal rate of about 40%. So in America, on that income that you're getting there, you're going to pay your 10% tax there in America, but the South African law states that even though you've earned the money outside of South Africa and you've paid your tax in the USA, if there's a difference between the tax rates, you have to pay that difference here in South Africa. So we structured it in a way using a credit loan account where we kind of legally bring down the tax as much as possible, and also using a limited liability company set up in the States to hold the property means we can distribute the expenses through the limited liability company for the property, and we can bring down the tax quite substantially. And we deal with a certified public accountant over there that keeps record of all of that stuff. So depending on the situation, means, yes, you can bring the money back and pay the bond here in South Africa, or you can keep the money outside in America. As long as you declare the earnings and you pay the tax here in South Africa, then it's all 100% legit. Hope that answered your question there. So now the probability of good capital growth. So I've mentioned this a few times. I think there's a few fundamental economic factors. Now, I'm no economist, but I read a lot, and I've been delving into this so much over the last year that I've really learned a lot about the whole economic factors driving certain things in the United States. Now, they reached $14.2 trillion earlier. They actually just passed the $15 trillion debt mark now in the last week. And just to give you an idea of how much money that is, here on the left-hand side, this is about $1 billion. On the right-hand side here, and that's the scale next to a man. On the right-hand side here, that's where the size of the Twin Towers and the Empire State Building. This one here on the right is $11.5 trillion. It's that little bit over there in relation to the Statue of Liberty and the other pile. That amounts to $11.5 trillion. So $15 trillion is a lot of money, and these are $100 bills all stacked on these crates that are then piled up like this. So it just gives you a general idea of how much money that is. It's mind-blowing, which means they're in a lot of crap. In August, they increased their debt ceiling to over $17 trillion up to 2012. The reason they did that was because the tax base in the USA, how much income is coming in, is only covering about 60% of their expenses. So the interest that they have on that $15 trillion and all of their social security plans, their 401ks, their retirement benefits, the new national health plan that they have there, all of those responsibilities that the government has to pay, they're only generating enough income out of their tax base to cover 60% of that, which means they've got to borrow the other 40%, which means they're taking from one credit card to pay the other, which means they're in deep financial crap. And what's happened is, because China was one of the main people, or at least countries, supplying all of that money, when they saw the USA taking steps to effectively inflate themselves out of that debt, they call it quantitative easing. Basically, it's printing money to buy financial assets. And when they started doing that, the money that they print, that they put out into the currency supply, basically reduces the value of the existing supply in the market. So what they're doing is they're deflating the value of that debt in order for them to make it manageable. So they're effectively creating inflation so that they can inflate themselves out of that huge debt problem. So what actually happened was, because China saw that, they kind of stopped loaning their money, not officially, but it's becoming more and more difficult for the USA to get access to that kind of credit. And it's also one of the reasons why Standard & Poor's dropped their credit rating from AAA to AA+. And it's the first time in history that they've dropped the rating of the USA. So it's a very key aspect why the economy is in huge crap. At the moment, the US government makes up 50% of USA GDP. So they're paying about 50% of the GDP of the cost to keep their country running. It's mind-blowing. And there's a very low supply of new property coming through, as I spoke about earlier. So all of that are these factors that are driving capital growth, because when inflation happens, it drags prices up of everything, food, rent, everything related to that currency is dragged up because of inflation. So I've already spoken about this. So the goal of quantitative easing, of printing more money, is to stop deflation and stimulate the economy. And effectively, to stop deflation, you have to create inflation and possibly even hyperinflation. Some economists are predicting that the US is going to go into hyperinflation mode over the next 3 to 5 years. Gold is going to go through the roof. Property is going to go through the roof. All sorts of things are going to happen. And I think we're sitting in a key position here in South Africa to really take advantage of that particular situation. And when the banks start loaning money again, now remember, the way the banks create money is by loaning money. They have that particular ratio. In America, it's 1 to 12. That for every $1 that they have in actual currency available, they're allowed to loan out $12. So once they've loaned out $12, it becomes an asset on their books, which means that $12 now creates 12 times the amount that they're allowed to loan out. So it becomes this ever-increasing amount of money that they can create out of nothing because they can loan money. And when they start loaning money again over the next 3, 4, 5 years, the Americans that are currently in that bad credit situation, who have maybe rehabilitated themselves, because as very similar to South Africa, after 5 years of being listed as a bad credit risk, it kind of comes off your name, and then they can start borrowing money again. So when those people are able to borrow money again, and the banks have money to loan out again, it's going to start driving prices up because there's going to be a supply and demand problem. And as supply decreases, demand is going to increase. So the result is prices are going to go up, and we're going to experience some enormous capital growth. So the 3 steps required to actually take advantage of this are the setup phase, the sourcing property phase, and the continual management phase. Now, the setup phase is basically, in order to buy the property there in the States, you have to get registered for tax in the USA. So you need a tax number, an ITIN number. If you're planning on buying more than one property, it's highly recommended to set up a limited liability company. You can buy in your personal name, but you also want to separate yourself from your investment as much as possible in order to lower your risk. So it's recommended to set up a limited liability company there and run your property investment through that company. It also allows you to process all of the expenses and lower your tax. If you have more than one member of the company, you can distribute the tax amongst all of the members because it acts as a pass-through entity. So there are a whole bunch of reasons why a limited liability company makes a lot of sense. Once you've got those things set up, you've got to get bank accounts open so that you can actually move your money across to the States into your own bank account and then use that as a basis to buy the property. So those are the things that you have to do in order to start looking for properties. Once you've got that set up, then you can start looking for properties in the United States. So step 2 is sourcing the properties. So you've got to be able to do the research and analysis and know what you're doing. The reason why my wife and I, Linda and I, went over there was to do the on-the-ground research, talk to the people there, meet the people, and figure out who we're going to be dealing with over there, drive through the areas so that we can see what areas are good, what areas are bad. And that's why we're focusing on one area, because we've only been to one area and we've only focused on researching that one area. And that's why we can only help people in that one particular area. Until I've been somewhere else and I've actually experienced it down on the ground, I can't help anybody. So do your homework. Fly over there, go drive around for 2 or 3 weeks, go look at 40 or 50 properties like we did. We actually looked at way more than that. And get a feel for what's actually going on the ground, what kind of rental returns you can get physically, how close is it to schools, how close is it to churches, to transport, to, that type of stuff. Also, what's very key is seeing the other type of people that are staying in that particular area. When we were in Miami, for example, driving around, one area was very Latino, another area was very white, etc., etc. So depending on what you want and the type of people that you want in your property, you have to go and do that on-the-ground research. And you're not going to find that unless you actually have somebody trustworthy that you've dealt with over there, or you've physically gone over there yourself and you've researched it yourself. Then document management, very key here. We're dealing with 2 countries, with the IRS in the States, with SARS here in South Africa. Keeping record of everything is imperative. Doing the books correctly. Quotes and repairs, also very, very important. If you're going to get a builder to do work over there in the States, how do you account for that? Who manages it? Who goes out and takes before and after photographs? That type of stuff. So it's very key to have a relationship with somebody there on the ground that can go and physically see it for you and give you some feedback before you spend money with these types of people. And then just a quick thing here on the difference between the different types of sales. An REO is a bank-owned property that's been through the foreclosure process, and is now a property in possession by the bank and is now being sold. It's exactly the same as a vendor sale, as a normal person selling their property. The bank owns the property or a person owns the property. It's exactly the same process. They're just called two different things. Sorry, just having a sip of water here. Then a short sale is a completely different type of sale where a person who's sitting in a property where he can't afford the repayments anymore, and the property value is lower than the amount of money that he currently owns on the mortgage bond. What will happen is he'll be in the situation where he can't afford the repayments and he can't really sell it for the amount that he owes on the mortgage, so he goes to the banks and he says, can I put it on the market as a short sale, as in a sale below the amount of money that's outstanding on the mortgage bond? Then the bank will either say yes or no, depending on the situation. If you really can't afford it, then it goes into the short sale process. And he stays in the property and maintains as much of the repayments as he can while that short sale is happening. But what happens with that is many times there's more than one bank involved in that particular property. There might be a second mortgage on the property or a third mortgage. So it becomes very, very technical to try and manage a short sale. And so if you place an offer, let's say a property is worth $50,000 and the outstanding mortgage is $100,000, but there's a second mortgage on it for $20,000, and you place an offer there of $50,000. Then that offer's got to go to the owner. He's got to accept it. Then it's got to go to the first mortgage holder, the first bank, and they've got to accept it. Then it's got to go to the second mortgage holder, and they've also got to accept it. Or they've got to negotiate between the three of them who's going to get most of the money and who's going to take the biggest bath. So those negotiations take a very long time, up to 6 months, 9 months, a year sometimes. So it's a very difficult way to take advantage of the situation. But if you're willing to wait it out, there are very good deals to be had in the short sale process. And then the foreclosure process is basically when the short sale process doesn't work, the guy stops paying his bond, the bank repossesses the property, tries to sell it on auction, and basically that's the entire foreclosure process. And those are the different types of sale that can happen in the States. So you're just going to be aware of which one you want to go for and focus on in order to get the kind of results that you want. And then ongoing management. So if you've now bought your property and you're happy with it, you've got to employ a management agency over there that has some credibility. They've got to have at least a 24-hour-a-day, 7-day-a-week emergency contact number with a call-out crew that will go and fix something if there's something wrong with the property. So you've got to make sure that they've got that, because if they don't have that, you don't want to get an email and then have to find somebody over there, a plumber or an electrician or whatever the case may be, at 4 o'clock in the morning here in South Africa because the guy's bath is not draining or the toilet's blocked up or whatever the case may be. So you want somebody on that side that can deal with all of that stuff. You also want to make sure that they can install the tenant, that they can actually market correctly and find the right type of tenant for you and vet him and get him in and get him paying. Then you want to also measure your investment regularly. See what other properties have sold for in, let's say you bought in a particular area or in a particular complex. You want to keep track of what other units in that complex have sold for. The tools are pretty easy. They're all freely available online. So you just want to go log in maybe once every 2 or 3 months and measure your investment so that you can see whether it's going down or going bad or whatever the case may be. Also keeping track of what other people are getting for rental in that type of area so that you can measure when your rental should go up, that type of thing. Quarterly reports, yearly reports, go into a little bit of depth and check what's going on with your property and just draw up those reports so that you have it. And keep record of everything, because unless you're measuring your investment continually, you're not going to know whether you're getting a good return or a bad return, whether to exit that investment and move into something else that might give you a better return. So unless you're measuring it, you're never going to know. And another key thing is bookkeeping. Once again, we're dealing with the IRS in the States. We're dealing with SARS here in South Africa. You need to keep accurate record and have a certified public accountant there in the States do the tax returns for you there, and have a chartered accountant or whoever deal with your tax here in South Africa, so that it's all legal and above board, and it's done regularly, exactly when everybody needs it to be done. So those are just some of the steps that you need to follow if you are going to think about buying property outside of South Africa in the USA. And A couple of questions that I've had over the last, few months doing this and helping some people is, what happens if a tenant doesn't pay? What happens if a tenant doesn't pay? I actually sat in an office with an attorney there trying to figure out the legalities related to all of this stuff. And I had 1,000 questions for the guy. And I asked him this particular question: what happens if a tenant doesn't pay? And he said to me, well, we send him an eviction notice. And I'm like, well, how much does it cost? And it's a few $100s and this and that and the next thing. And I said, but what happens if he doesn't move out? And he was like, well, why wouldn't he move out? Because we served him an eviction notice. So then I was like, yeah, but what happens if he doesn't move out? Kind of like here in South Africa, where we have the PI Act, which protects the tenants, and they don't actually have to move out. And we as landlords sit in a situation where we have to take matters into our own hands sometimes, and it can get very, very ugly if you've got a tenant that won't move out of your property and is not paying you. And he was like, no, well, we just phone the cops and then they move out. So he couldn't understand that we would have that type of problem. They get served an eviction notice and then they actually move out. So there's laws there that protect the landlord very, very much as protecting the tenant. So if somebody is served an eviction notice, they move out. It's just that simple. Another question is, what happens if an appliance breaks down or a drain blocks up? I've already covered that. You want to have a management agency that's got all of that stuff covered. They've got a 24-hour, 7-day-a-week call-out number. You also want to have possibly an insurance policy to cover the appliances, because if the appliances break, you want to know that the insurance policy is there and they'll just roll in and replace it or fix it or whatever the case may be, and they're really, really cheap. So it's really worthwhile taking out an insurance policy on the appliances. So you're going to have those two things in place. What happens if a service provider doesn't answer an email or takes long to get back to you, that type of stuff? It's very key that you deal with the right people. Spend some time doing some research. When we employed a managing agency to find a tenant for our property, we went through a long process and a whole bunch of agencies, and I asked them for some of their clients' details so that I could get hold of them, got on the phone them, asked them what kind of experience they've had, how did the people deal with problems, how did they deal with tenants that didn't pay, etc., etc. And we eventually went with a particular company that had absolute rave reviews from every single person that I phoned. And to be honest, to date, they've lived up to every single review. They've kept us up to date with feedback. They've responded to emails consistently. They've sent us photographs of the repairs. They managed the repairs for us. They sent us before and after photographs. They really went above and beyond the call of duty to really help us because we're so far away. And I was blown away by the service levels on that particular company. So try and find somebody that can do that for you. Another key question is, what happened if a tenant sues me for something, for falling down the stairs, whatever the case may be? Take out public liability insurance. It's cheap and it's worth it. Let them deal with an insurance company instead of with you. And then another key thing here is, everybody knows that cliche: if I'm far away from my investment, what happens with it? And because of the protection, and we're playing on a global level here nowadays. The world is smaller than it was a few years ago. It's easy to get on a plane. It's relatively cheap, and the prices are going up because of AXA and all the rest of that stuff. But it's really not that impossible. If you've got an investment worth R500,000 or R1 million in the United States, to spend 15,000 Rand to go over there on tickets and stuff, if there's a huge problem that absolutely can't be dealt with in any other way, then get on a plane and go and check it out. So worst case scenario is that's what has to happen. So if you're far away from your investment, that is a factor that you need to take into account. But if you put the right people in place that really, really help you on the other side, you don't need to worry about that very much. And ultimately, I love having income in dollars. I mean, I've had a 15% increase in our rental over the last 2 months purely because of the Rand-dollar exchange rate changing. So I'm quite stoked about that. Obviously, the Rand-dollar can go in the other direction as well, but I'm quite happy that we've had a 15% increase without actually having to tell the tenant to pay us more money. So what about the tax? I've already spoken about this quite in depth. I'm not a tax expert, so please get advice from your tax experts. But some key stuff here is, if you've got more than one member of the LLC, it acts as a conduit entity, so you can distribute the tax liability to all of the members of the LLC. So that's quite a key concept to keep in mind. And we can effectively, on a small portfolio, reduce the tax liability to pretty much zero using a credit loan account and some good accounting practices to make sure that you're getting the best from your investment. So why are we uniquely positioned here in South Africa? Because we are an emerging market. We're a third world country and that type of stuff. As the USA tries to inflate its way out of that huge debt problem that it's in, it has a huge effect on emerging markets. As we've seen recently with Greece and the Eurozone crisis and all the rest of that stuff, it put massive pressure on the rand, and we lost 20-25%, somewhere around there, over the last 2 months, and then it retraced a little bit now because the Eurozone, there's a few key nations that have said they're willing to bail out Greece again and put a new treaty in place, which we'll wait and find out how that works out next week. But, it's going to be interesting times, definitely. And as the USA inflates its way out of debt, the world fear makes everybody exit emerging markets, and that means the rand takes hit after hit. And we're also sitting in a unique position because it's never been higher. The amount of money that we can actually move out of South Africa legally for foreign investment has never been as high as it is now. It's 5 million rand. You can actually apply for more to the Reserve Bank, but 5 million rand is what you can actually get as long as you've got 5 million rand available and you can get a tax clearance certificate and all the rest of that stuff. You can move 5 million rand out relatively easily. And we've never been able to move that much money legally before. So it's a very fundamental thing about having the opportunity to do it, which we haven't had before. And the reason they're doing that is if they've got more people in South Africa moving rands out of South Africa, creates a supply and demand problem, and that keeps the rand dollar in check so that they can kind of, keep that export thing happening and keep the rand relatively weak, so that the exports are doing really, really well. I mean, obviously our economy relies heavily on exporting of commodities, of minerals, of foodstuffs, of automobiles, all of that stuff. We do really, really well when we have a weak rand, and it's a fine balance between the weak rand and a strong rand. But ultimately, a weak rand serves the entire economy a lot better than a strong rand. So it's become easier than ever before to play on a global level. And because of our political situation here in South Africa becoming more risky by the day, we've got to try and offset that risk. We've got to be aware of it and take steps. And ultimately, if I'm going to be betting on a country, I'd be betting on a first world country before an emerging market. And a lot of people say, but emerging markets, that's where the growth is. But they're relating that back to high risk, high growth. And I kind of don't believe in that. I believe in mitigating risk, in reducing the risk as much as possible in order to create the most amount of growth. So let's talk about the risk for a brief minute over here. The money doesn't disappear when you buy a property. It only transfers from one state to another. So it goes from being cash to being a property with intrinsic value. And in that transfer, that's where you're creating the growth. So the property, as it provides income, it's reducing that growth or at least reducing the risk, continually. And then once again, there's laws that protect the landlord as well as the tenant. So your risk is much lower there. We don't have a situation there with something like the PI Act. So you have a lot of law backing you as a landlord in the USA. So if you're buying for $60,000 with cash out of your own pocket, at a net yield of around 10%, and we've already proved that we can get that relatively easily, that means that $6,000 per year, with no rental increases and no inflation, all of that type of stuff, it would take 10 years to recover the full amount of capital that you've laid out. And if you apply the accelerator principle, now this is one of Hannes Streyer's principles, if you took that $6,000 a year and applied the accelerator principle to grow that portfolio as fast as possible, you could create exponential growth in that same time period, and it would be mind-blowing how many properties you could actually purchase just using the initial $60,000 to create the leverage. So what's the upside? If we invest in USA properties right now, we're looking at there's lots of stock available. As we saw, 1.7 million homes going through the foreclosure process at the moment. We've got 2 years, roughly 3 million homes expected to go through the foreclosure process up to 2013. So there's a lot of low-price, good quality properties. Good rental returns. We can see that the fundamentals they're driving rental growth are very, very strong because those people, everybody that was foreclosed on, needs to rent because they can't borrow any more money to buy. So they need a place to live. Shelter is one of the fundamental needs of humans, and they have to rent. They also downgrade quite a lot. So the particular target market that we're looking at in the $60,000 to $100,000 range, people that were foreclosed on in the higher property price brackets would be downgrading into those properties, creating a supply and demand problem. So there's good rental returns with good tenants. The probability of good long-term capital growth with that whole inflation system happening, with us being an emerging market over here, there's going to be a double whammy growth. There's going to be the inflation-driven growth in US dollar terms, and then there's going to be the US dollar versus the rand, which I expect. I'm no financial guru. I've done a little bit of forex trading and that type of stuff, but I think that the rand dollar, because we're so indelibly linked because of our export trade, we have to find a way to devalue our currency at the same rate that the dollar devalues its currency, because we are reliant on that. So we have to do it in South Africa because of our link to the US dollar and our strong reliance on exports for money. And then we want US dollar-based income to offset against the rand. So if we've got income outside of South Africa, we're in a little bit more control and we're offsetting our risk. We've got a plan B, we've got something a little bit more real, and I think it's a very good thing. And that's why I believe we should be buying in the USA right now. The market is as down as it's ever going to be. I think it's what we've all been waiting for as property investors for years and years, and I don't think we're going to see it this good for a very long time, so we should be taking advantage of it. And then this is the part where I go into the sales pitch. So if you want to do all of this type of stuff, we're here to help you. We've gone through it. We've got relationships with people on the ground over there. If you don't want to go through all of that stuff yourself, you obviously can. You've seen some of the tools that I use. It's very easy to go find other tools and be able to find these properties and get tenants installed. But if you don't want to go through all of that yourself and you want to leverage off what we've already done, you're welcome to employ us to do that and help you along the way. So the setup phase, to get a limited liability company set up in Florida, to get individual tax numbers for foreign investors in the States, to get a US dollar bank account open for the limited liability company, and then to get US dollar bank accounts open for the individual members of that company, we charge 39,500 Rand, including that. Most of that money, there's actually very little profit in that. That setup phase is all about getting the paperwork structured right, and most of it goes to courier as well as services from the certified public accountants in the States to get all the paperwork set up correctly for foreign investors. A lot of people say, oh, but you can just buy a limited liability company online for like $200 or $300 or whatever the case may be. Once you have that limited liability company, you then have to go through all the paperwork to get a tax number for it. If you don't know what you're doing, you're going to end up spending more money anyway. If you don't structure it right, you're going to end up spending more money. So there's a whole bunch of factors there. Use a public accountant, pay them the money that they deserve to do it right, and just let them handle it. So that's it. Then sourcing properties. You can obviously source properties yourself. All the tools are there. But if you want us to help you and do the full analysis on each property, actually find the right ones that can give you phenomenal internal rate of returns, phenomenal yields, then we charge a 10% finder's fee on the purchase price of the property. So, for example, if we find one for $60,000, we're going to charge you a $6,000 commission once you've actually purchased that property. So what do we do for that money? We find the suitable properties. We investigate the history, the previous sales, the comparative market analysis, the tax history, the homeowner association, how many properties are standing vacant in a particular complex, all of that type of stuff. So we investigate that history. We also handle all of the communication the offer to purchasers, all of the documentation that needs to go with. We deal with the conveyancing attorney, the sales agent, the buyer's agent, all of that type of stuff, and keep it all in one place so that we've got the record of everything. And we also make sure we validate the information through trusted partners. It's very, very key is to get the people down there on the ground to actually go and check whether the stuff that we find is actually the real figures. And that's what we do for that 10%. And then ongoing management. This is just to measure the performance of the investment over a specific time period. So we'll manage and keep record of all communication with the management agencies there in the States. We'll verify information on the tenant installation. We'll follow up on rental payments. We'll analyze the property and report once every quarter so that you can see, did a toilet break? Did the guy actually pay his rent on time? Are there broken tiles in the place? We'll analyze the property and the homeowners association and the area and all the rest of that stuff once every quarter and give you a basic review. We also do the basic bookkeeping of the limited liability company, and it's hosted on we don't actually do it. We keep record of everything on an Excel spreadsheet, and we just send that through to the accounting agents there in the USA, and they keep the books on a QuickBooks system that is hosted on a cloud server so that you can log in anytime and go and see if your bookkeeping is up to date. And you'll have contact with the accountant, with the managing agents, with anything. So if we fall off the planet for whatever reason, you'll always be in control and you'll be able to take over immediately and not worry about somebody that's managing it for you, and then you don't know what's going on with your investment and that type of stuff. So you'll always be in the communication loop at all times. And for that, we charge 950 Rand per month, expat per property in there. If there are bigger portfolios, if there's somebody that really wants to go mad and buy up the whole of the United States type of thing, we can obviously negotiate and figure out a deal. Or with what you've learned here, hopefully you can do it all yourself, or you know more or less, you know enough to be able to go and find out more and verify everything that I've said here and maybe do it yourself. And I really hope that you do, because even if you don't use me, I really, really hope that you take advantage of this now, because we should be buying as many properties as we can in the USA. Between Linda and myself, we've got a goal to buy 20 over the next 2 years. I'm doing everything I can to realize that goal. And I really hope that everybody else on this webinar tonight takes the same action and finds some amazing properties there in the United States. And in 10 years' time can look back and say that was the best decision they ever made. And they've got a portfolio of property outside of South Africa generating dollars that their kids and their kids' kids will be able to live free of the income that it generates. And that's my passion, my dreams. So hopefully you'll be able to do all of that for yourself. If you want to get hold of me, you can reach me on my cell, 082-3300-570, or on email, brendan@usapropertyinvestment.co.za, or go check out the website. There's a lot of information on there, comparison of gold versus property, why I believe property is better, all sorts of things. So go check out the website and do a little bit more research. And then thank you very much for spending this time with me tonight. I really hope that you guys learn something and maybe take some action. I just want to see if there are any other questions here. If you guys do have questions, please post them up. So we've got one question here. Can you get a bond? Thank you for the presentation. It's a pleasure. Can you get a bond in the USA? There's after a year of income in the USA. Okay. Yes and no. It depends on the application. Effectively, with your limited liability company, I believe that yes, because you're creating a credit history there in the United States with that company, with that income based on a property that is effectively paid for in cash, you should be able to apply for a bond over there and actually get it with a year's trading history. I don't know yet because I haven't actually done it. But that's a very good question, because I'm actually helping some other people where we're going to be structuring a type of syndication type of thing where one limited liability company might hold upwards of 20 to 30 properties. And now all of those properties that are held in that one particular syndication are generating huge amounts of income, which has all been funded for out of cash from the investors. Now, because of that income, if we can create a credit history and actually apply for finance in the United States based on that company's income, and we've got our 2 to 3 year window, it means we can grow that portfolio using leverage in the United States. So we can get bonds on that income, which means we can exponentially grow that portfolio. So yes, the theory is there. We verified it with the attorneys and with the accountants in the States, but I haven't actually physically done it yet. But I do believe it's possible, yes. So thanks for that question. It was a very good question. It looks like we're done. Thank you, everybody, for joining me on this presentation tonight. I really enjoyed presenting it because every time I talk about this stuff, I get more and more excited. So thank you guys very much. I hope you guys learned something. And if you have any questions whatsoever, please just give me a call or drop me an email, and I'll be happy to assist you. Thanks very much, and good night.